Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I have two paper money trades for you today on two high-profile names. We'll look at Nvidia and we'll look at Palantir, but we'll also focus on Vega, right? We know that in today's markets, volatility has been high, but at least today, volatility is coming down. How do we trade the potential for implied volatility coming down in two high-profile names? We'll go over that right now. Let's get to our first one, which is Nvidia. So, Nvidia, when we look at something in short Vega, we can look at the short put vertical. So what I did here in Nvidia, I looked at the expected move. I went out till May 2nd, so 24 days. And I looked at the expected move of $15. I went a little inside that, so I sold. Now we're selling the May 2nd 95.85 put vertical in Nvidia. And so we're doing that for a credit. I put it in at 195. It's trading closer to 155 now as Nvidia has continued to rally. But the most important part is this is a high probability short put vertical that collects theta, that is risk defined and is short Vega. A one lot spread has a negative Vega of 326 right now on the Thinkorswim platform. That means for every point in implied volatility Nvidia were to go down, that would be more profitable. Now, the most you can make on a trade like this, as you know, is the credit taken in. So if you sell it for 195, if you sell it for 155, the credit taken in is the max profit. Now, the max loss is different. It's the difference between $10, the width of the strikes, minus the credit taken in. So if it was 195, it'd be 805. If it was 155, it'd be 845 would be the break even. You see how that works. The difference between the strikes and the credit taking in. So the break even is the short strike, in this case the 95, minus whatever credit you took in. So if it was 195, we'll work off our first number. If you 195, the break even would be 93.05. The 95 strike minus the 195 taken in, that would be the break even. Remember, the risk is the width of the strikes minus the credit, and these are short Vega spreads, so they would benefit from implied volatility coming down. Okay, that's our first trade. Now let's get to our second, which is Palantir. Same dates, May 2nd we went out to. This time we sold the 75.65 put vertical in Palantir. We have that in for 185. It's trading about 175, 180 right now, so only slightly lower than where we put it in. And again, let's deal with 185. If you sell this for $1.85, that's the max profit on this trade. The risk, the difference between the $10 strikes minus whatever credit you took in, that would be $815 is the risk on this trade. And the break even is the short strike, in this case the 75 minus the credit taking in, which takes you to 73.15. So, but the short Vega on this put vertical is about 260. So again, that benefits from implied volatility coming down, and the risk would be implied volatility going up or a move through the $75 strike. So two trades in Nvidia, Palantir, both May 2nd short put verticals that focus on two things: a high probability put vertical that collects theta and is risk defined, but also short Vega, benefits from implied volatility coming down. So those are our two trades for today. I'll see you tomorrow with another edition of Daily Trader. I'm Kevin Hincks.